Hi there, Zach Silverman from Silverman Mortgage Group. I hope everyone's doing really great. Bank of Canada announcement yesterday that they have cut the prime rate in Canada by another 0.25%. That's the second one in a row. That brings prime lending rate at most lenders out there and banks to 6.7%, with TD being the outlier at 6.85. So what that means for us is that the Bank of Canada has said that they will continue to, of course, monitor economic conditions. Inflation is slowing down. There are significant headwinds. The other important thing that the Bank of Canada has come right out and said is that shelter costs, including rents, mortgage interest costs, etc., are significant contributors to our inflation numbers. And so we do expect to see additional rate cuts this year as well as ongoing. So Bank of Canada is very likely headed towards their more neutral interest rate environment, which brings the overnight rate to 2.5% to 3%. And if that's the case, that would bring prime lending rate down in around the high 4s to around 5%, which is kind of historical norms. It's certainly not COVID lows that some of us saw, but it's absolutely more palatable. And so what that means to those people with variable rate mortgages or lines of credit, your payments and your interest costs will lower in the coming days here. And so you'll see per $100,000 of mortgage on a 25-year amortization, you'll see your payment come down by about $15 per 100,000. So as these rate cuts do continue to happen, it will make a significant difference to your cash flow. And moving forward, what that means for borrowers is that variable rate strategies are back in the mix. So variables today, you're now at about 6%, a little bit lower, so upper 5% for a variable today. So depending on if you're looking to renew, refinance, purchase a new home right now, that's absolutely one of the strategies that we're going to recommend, of course, depending on your personal outlook. For the more conservative borrower, 3-year fixed rates are going to be, in my opinion, the other good option. 1 and 2 year rates right now are elevated. The interest rates are higher, and I just don't know that they're worth that premium over the 3-year fixed. And in my opinion, 5 years, which is going to be a little bit lower than the 3-year, I think it's just too long to lock into, knowing that we're going to continue to see interest rates coming down. And so what we always try and do is focus on the big picture, help you guys pay the lowest amount possible on your mortgage. And so that's not always by the lowest rate today, but we're going to look bigger picture, longer term. And so when you're thinking variable or 3-year fixed, etc., consider that if you are going the variable strategy, the idea is you can stay really agile. As rates come down in the variable, you'll continue to have lower borrowing costs. Also, if fixed rates continue to come down, which we expect that they will, at any time you can kind of jump ship from the variable and convert that to a fixed mortgage at hopefully lower rates than today's options. So that's kind of what we're looking at today. Hopefully this is helpful. Please don't hesitate to reach out and schedule a call. Happy to help, happy to chat through your existing mortgage, any future needs that you have. And we'll be by your side whenever you need us. So thanks so much, and we'll chat with you soon.